Life Technologies Corp. was created by combining the companies Vitrogen and Applied Biosystems in November 2008. However, it has been functioning as a public company since February of 1999. The orange line on this graph shows earnings per share growth since that time, and as you can see, the company has averaged over 30.6% per year compounded earnings growth. There has been a modest amount of cyclicality along the way. I think it's very straightforward to suggest that this company has had extreme growth since it's been a public. When monthly closing stock prices are overlaid and correlated to the earnings growth, we can see that there was a time, like most companies when they first go public, have a lot of hype, but then since August of 2002, you can see that the company's black stock price has correlated and tracked earnings very closely. Of course, the recession of 2008 caused this company, as it did many others, to become trading at a valuation that was historically low. The orange line represents a calculation of intrinsic value using the price-earnings ratio equals growth rate or PEG ratio formula. As you can see, this is the lowest valuation that this company has traded at since it's been a public company. When you look at the track record of this company since it went public on February 26 of 1999, $100,000 invested on that day would have bought 13,000 shares, and today they would be worth $603,000, averaging 14.7% per annum. Since this is a growth stock, if you compare that to the Russell 1000 growth, you can see that it's only averaged 1.2% over the same time frame. So this company has obviously generated a significantly above average and indice-beating track record since it's been a public company. Right now, the consensus of 23 leading analysts reporting to Capital IQ only expect this company to generate future growth of 10% a year. However, if it achieved that growth by the year-end 2017, the stock would be worth approximately $95 a share if it traded at 15 times earnings. It would also then generate a 13.4% average annualized rate of return. However, if you redraw this chart looking at only the last 5 or 6 years, 5 and 1 a fraction of a year, or in other words, since 2007, we discover that the earnings growth rate has averaged 31.5%. If we plug in this higher number of 31.5%, or its average 5-year growth rate, we'll see that it has a dramatic effect on what the potential return of this company would look like. At a 31% growth rate, investors could expect this stock to be as high as 409, without splits by December 31st, 2017, representing a 46.3% compounded rate of return. Personally, I believe that that is a very doable number, and one way to get a feeling for that is to go into the company's website and look at all the many exciting products and services and various tools they have, and some of the most cutting-edge life sciences available anywhere. And some of these markets have, as I mentioned in the article, trillion-dollar potential. So I believe that this is a company certainly worthy of the aggressive growth investors' further consideration. There's a lot of potential in this company. I think it does require patience, but it's one that is certainly worth looking more closely into.